China has just imposed a staggering 125% tariff on U.S. exports, but that's only the tip of the iceberg. The real story, however, isn't about tariffs at all. It's about a silent, calculated shift in global trade, one that is unfolding with such precision and speed that by the time Washington realizes the full scope, it may already be too late. This is not mere retaliation. It's a full decoupling of the U.S. and Chinese economies, and it's happening faster than the West is willing to admit. On April 10, 2025, China took its most significant step yet, targeting key sectors like American automobiles, tech machinery, and semiconductor parts, industries that accounted for over $36 billion in U.S. exports just last year. This was no coincidence. It came just 72 hours after President Trump authorized $88 billion in new tariffs on Chinese electric vehicles and rare earth minerals. Bloomberg analysts called it a precision strike, not just a pushback, but a direct message from Beijing. This is no longer about defense, it's about surgical offense. China is now targeting industries crucial to U.S. politics, industries with deep electoral ties. The market's reaction was swift and severe. Tesla immediately halted shipments to China. Deere & Co. lost $2.1 billion in just 2 days. U.S. soy futures plummeted by 4.3%, signaling broader concerns about retaliation. But beneath the surface of these headline-grabbing numbers, something much more profound is taking place. China didn't just respond, it repositioned itself. This wasn't a trade rebuttal. It was a strategic withdrawal, a calculated exit. While global attention fixates on the tariff headlines, the real shift is structural. According to China's State Administration of Foreign Exchange, Beijing slashed its U.S. Treasury holdings to a 15-year low of $668.6 billion in the first quarter of 2025. But that's only the beginning. The China Construction Bank and ICBC have stopped issuing dollar-denominated loans for state-backed projects, instead turning to financing backed by the yuan or euro. This is a significant pivot, part of a broader internal strategy designed to reduce reliance on the U.S. dollar. This isn't just hedging risk. It's about fully decoupling from U.S. financial systems, and the signs are clear. Goldman Sachs economist Maggie Wei has warned that China is engineering a soft exit from dollar-linked liabilities, anticipating future sanctions. But if China isn't merely reacting to the next round of tariffs, what is it preparing for? Then, on April 11th, China's Ministry of Commerce made an announcement that sent shockwaves through international markets. Certain U.S. imports, they said, were now no longer commercially viable. At first glance, it sounded like bureaucratic jargon, but there was a deeper message buried in the words. By labeling American goods as economically inefficient rather than politically undesirable, China is shielding itself from potential WTO retaliation, while quietly instructing domestic companies to sever ties with U.S. suppliers. It's market-based decoupling, a quiet unraveling of supply chains that the West may not even notice until it's too late. Just days after the announcement, BYD dropped a $500 million sensor supply deal with a U.S. firm, signaling that this process is already underway. And the world is already responding. Behind closed doors, key U.S. allies are hedging their bets. In March 2025, Germany's BASF signed a record $7.2 billion expansion deal in China's Guangdong province, despite mounting pressure from Washington to reduce dependence on China. Saudi Arabia finalized a landmark oil deal with China's Sinopec, settling entirely in digital yuan, bypassing the U.S. dollar for the first time. France is lobbying for a BRICS EU observer forum, and Brazil is pushing to integrate Chinese-backed regional payment systems with its own. These aren't isolated moves, they're part of a slow but deliberate pivot away from the U.S. and toward a multipolar global order. As Citibank strategist David Lubin warns, a multipolar trading order is emerging, and Washington is no longer the default center. America's sanctions toolkit, once a pillar of global power, is quickly becoming less effective. As of April 2025, the U.S. has sanctioned over 640 Chinese entities, but trade volumes remain resilient. In fact, China's exports to ASEAN countries rose 7.4% year-over-year in the first quarter of 2025, offsetting losses from the U.S. Meanwhile, the dollar's dominance in global trade is eroding. The yuan now accounts for 6.3% of global cross-border payments via the SWIFT network, up from just 2.2% in 2020. The shift is happening now, and it's happening faster than anyone can keep up with. By the time Washington even reacts, the global economic landscape may have already changed forever. The U.S. is no longer the sole leader on the world stage, and China, once on the outside, is poised to become the new center of global trade. The question is, will America even realize what's happening in time to stop it? The chokehold on Huawei's semiconductor supply, once seen as a potent weapon in the trade war, is beginning to falter. The company's new 7-nanometer chip, a breakthrough created using a high-risk workaround that combines Chinese lithography tools, Dutch equipment stockpiles, and pre-ban ingenuity, has left analysts at Tech Insights utterly stunned. What was supposed to cripple Huawei has instead fostered a new wave of local innovation. The irony is hard to ignore. Sanctions designed to stifle China's technological rise have now propelled it to self-reliance. Robert Lighthizer, former U.S. trade representative, begrudgingly admitted in a briefing at the Heritage Foundation, "We underestimated their ability to work around us. If these sanctions are backfiring, what's left in the White House's arsenal?" As Washington's strategy falters, Wall Street is already acting as though the situation is untenable. The market isn't waiting for a political solution. It's pricing in the growing economic pain. On April 10th, the Dow plunged by 1,000 points, erasing a staggering $520 billion in market value. China's retaliatory tariff hike, which struck U.S. agriculture, industrial machinery, and EV components, sent shockwaves through American companies. Archer Daniels Midland, one of the largest agricultural firms in the U.S., saw its stock drop by 11% in just 2 days, and Deere and CCR warned that over $3.2 billion in China-bound inventory could face immediate disruption. Goldman Sachs responded by slashing its Q2 U.S. GDP forecast from 2.3% to just 1.5%, citing direct exposure to retaliatory tariffs and an indirect drag from curtailments in exports. Former Treasury Secretary Larry Summers, speaking to Bloomberg Surveillance, articulated a growing sense of alarm. "The markets are signaling something the administration hasn't fully processed. This isn't just a trade fight anymore. It's an economic firebreak, a divide that's growing wider every day." But an even more pressing question is emerging. What happens if corporate America, now absorbing the financial blow, demands a truce, while Trump's base, still riled by the conflict, continues to call for escalation? Xi Jinping isn't counting on a swift resolution or a quick victory. His strategy is built on endurance, playing the long game. Since 2021, China has ramped up its domestic chip production by an impressive 34% annually, according to the China Semiconductor Industry Association. At the same time, Beijing has drastically reduced its imports of U.S. soybeans from 32 million metric tons in 2018 to just 9.4 million in 2024, according to USDA data. China has strategically locked in multi-year grain deals with Argentina and Kazakhstan, further insulating itself from potential supply shocks. In addition, Beijing has ramped up its sovereign food reserves by 18% year-over-year, reinforcing its resilience against global trade disruptions. In April, the People's Bank of China, PBOC, revealed that it was actively shifting its foreign reserves away from dollar-heavy holdings, an explicit move designed to shield China from U.S. financial leverage. This shift in reserve management is part of a broader effort to decouple from the U.S. dollar, insulating China from the economic weaponization of currency. Meanwhile, in the U.S., inflation is beginning to rear its head once again. According to the University of Michigan's Consumer Sentiment Survey, inflation expectations rose to 3.1% in April. As former Australian Prime Minister Kevin Rudd noted in Foreign Affairs, China's timeline isn't 2025, it's 2050. The real battleground is not about striking harder, but about which country can endure the pain of this conflict the longest. For American farmers, the effects are already being felt. Over $8.6 billion in agricultural exports to China are at risk by 2025, primarily in soybeans, corn, and dairy products. Iowa-based Cooperative Landis reported a staggering 37% drop in forward contracts with Chinese buyers this spring, and the ripple effects are being felt across the agricultural sector. Walmart's CFO, John David Rainey, warned during the company's April earnings call that tariff-related input costs are already pushing up shelf prices on core essentials. According to the Bureau of Labor Statistics, food prices surged by 0.6% in March alone, a rise heavily influenced by import shocks stemming from the trade tensions. This is no longer an abstract concern. It's an economic reality that's impacting everyday American consumers at the checkout counter. This escalating economic divide isn't just a temporary rift. It signals the beginning of a global redesign. According to the International Monetary Fund's (IMF) April 2025 Global Economic Outlook, global trade is fragmenting into distinct regional spheres of influence. China is leading a bloc that now controls 33.6% of global GDP, measured by purchasing power parity. This surpasses the G7's share, which stands at 29.9%. Meanwhile, cross-border investment flows between the US and China have dropped by an alarming 58% year-over-year, according to data from the Rhodium Group. Chinese tech giants like Xiaomi and Huawei are redirecting their manufacturing expansion to other nations like Indonesia, Egypt, and Mexico as they adapt to the new geopolitical landscape. On the U.S. side, Congress is considering legislation to prohibit federal pension funds from investing in Chinese equities, signaling a deliberate move toward financial decoupling from China. Despite these significant shifts, there is still no coherent, coordinated effort to reverse course, as Seth Carpenter, chief global economist at Morgan Stanley, pointed out. We may be past the point where the two economies can fully reintegrate. What we are witnessing is not just decoupling, it's divergence, a widening gap that can no longer be bridged. The question that now looms larger than ever is, if the old system is gone, what will replace it? What is the new economic order that is slowly but surely taking shape? The trade war has long since stopped being just a conflict over tariffs. It has become a strategic unraveling, unspooling one thread at a time. China is systematically reducing its reliance on the dollar. U.S. firms are being slowly carved out of global supply chains, and Wall Street is reacting in real time, recognizing that the old rules no longer apply. But the most ominous and profound warning shot didn't come from retaliatory tariffs or treasury divestments. No, the real tremor was felt in relative silence on April 5th, when China's central bank quietly confirmed that it had completed a cross-border energy transaction using the digital yuan. The deal, involving state-owned pro-China and an unnamed Middle Eastern supplier, amounted to $2.9 billion in crude oil, settled without a single US dollar. This is no longer speculative. It is happening now. If China scales this model and connects it to other global trade platforms, whether through BRICS, African nations, or Latin America, it won't just bypass the dollar. It will redefine the currency of global consequence. And that could be the first step toward a world where the US dollar is no longer the undisputed king of international trade. So, as the world watches, the real question we must now confront is this. If Beijing forces the next generation of global trade to settle in yuan, will Washington even have a seat at the table? As this geopolitical and economic shift accelerates, the stakes have never been higher, and the future of global power is on the line.